Howdy, Jacob here. Today we're looking at Cognex Corporation in the electronic equipment, instruments, and components industry. 8.7 billion market cap, 8.4 billion enterprise value. Very good return on invested capital. Last year appeared to be a pretty struggling year for them. 17% decline in revenue growth. The lowest gross margin of the last 10 years, lowest operating margin of the last 10 years, and lowest return on invested capital of the last 10 years. If you remove that, however, you are looking at very solid revenue growth, 426 million in revenue in 2014 to a billion in 2022, and then return on invested capital averaging in the mid to high teens, which is very substantial, and operating margin in the mid 20s, also very substantial. Balance sheet shows about 203 million cash on hand, 129 million short-term investments with no short-term debt, no long-term debt, just 69 million of capital leases for interest-bearing debt. No concern on the balance sheet. Very safe investment from that perspective. The cash flow statement shows pretty low capital expenditures in relation to cash from operations, but we're seeing the same thing where the most recent year is a bit of a troublesome year for them with free cash flow less than 100 million, the lowest it's been of the last 10 years, but still making money, which is positive, just less than before. Their use of money, their dividend pays up about 20%, 25% of their 5-year average free cash flow. They use a little bit of free cash flow for share repurchases and then also a bit for acquisition and reinvestment purposes. So let's start making some assumptions here on the revenue growth side. I think I'd be pretty comfortable with 5%. I think I'm saying that maybe they grew a little too fast, ran out of their shoes a little bit. They're going to put their shoes back on and start walking again. And I think 5% is reasonable for that. They don't have any debt and very good. They do have very solid return on invested capital. So I feel pretty good about market average, maybe slightly higher. Margins are decreasing a little bit. So maybe I'll do 22, 23%. Share change, they have been buying back shares, but they also issue quite a bit through stock-based compensation, and that's been growing quite a bit. So maybe we'll say they just offset stock-based compensation. Their dividend was only 25% of a payout ratio, but with the return on invested capital they have, I do want to leave about 50% of capital to go towards reinvestment and advantageous acquisitions. So to me, I feel comfortable with these assumptions, and we're saying the company stock price needs to fall about 80% to get to the price we're looking for. There's a lot more appropriately priced companies out there, so I will not be wasting my time on this until it gets to a price that looks more attractive to me. I hope you enjoy the video and have a great rest of your day. Thank you.